Hi everyone, welcome back to my channel. So in today's video, I'll discuss 4 main concepts of price action as it relates to supply and demand. Now, these all will be viewed on shorter time frames for the convenience of spotting precise entries and just managing risk tighter while also reacting quicker to momentum shifts. So you can see here I have 4 different charts pulled up, so we're going to go ahead and dive right into it, starting with Apple here at the top left. So with this pattern, we're going to identify a rally-based drop. Now, this price action pattern is heavily used to identify strong areas of supply zones, where sellers have previously overwhelmed buyers, causing price to drop. So understanding this structure helps you recognize areas where price might reverse or accelerate in the future. So to start, let me briefly explain what a rally-based drop is. It is a 3-phase structure where you'll see the price rallies to the upside aggressively, and this is of course with bullish candles, large ranges, little to no wicks for the most part. Now following that, you'll see a base that forms. And this is where price pauses or consolidates in a tight range. Typically, you'll see small candles with indecision or low volume. And then following that, you'll see that the price falls sharply, and these of course are going to be bearish candles, wide ranges with momentum to the downside. Now this sequence tells you that sellers stepped in at the base, and of course this is going to be the bullish move, and their aggression caused a sharp drop. Now the base becomes a key supply zone. And the reason why this matters is that the base is the battleground. So this is where institutions and smart money scale up on short positions or sell off on long positions. Now at this point, liquidity is pooled because some traders often enter late buys here thinking that the price will continue to rally to the upside. But in actuality, price slows to allow large orders to be filled without causing slippage. Now, when price returns to the base in the future, it's likely that unfilled sell orders still exist there, creating a low-risk, high-reward shortening opportunity. So what this looks like, of course, on the chart here, you can see again, you're going to see the ranges to the upside. That base is typically going to be anywhere from 2 to 6 candles max, and they're usually pretty tight. And then the drop to the sell-off is usually going to be a strong bearish move. Now, a high-quality RBD zone is typically also going to be a high probability supply zone. So you want to look for the strong initial rally to the upside, look for it to be fast and clean with little to no retracement, and then you definitely want to see a tight base, so the sideways candles ideally, depending on the time frame, along with overlapping bodies and small wicks. Now you also want a strong conviction of the drop, so you want these to be large bearish candles leaving the base quickly, and this confirms the institutional interest. This is also backed with surety since the price hasn't returned to the base yet. There's unfulfilled orders are likely still there. And then along with that is the proximity to higher time frame resistance because this adds confirmation and confluence to the trade. You're also likely to see the volume increase on the drop, and you can see that confirmed here. And this just confirms real selling interest. Now, if you wanted to, you could mark the supply zone and draw a rectangle around the base from the highest wick to the lowest body, but you always want to make sure you wait for the price to return. So being patient is super important because the first retest is usually the best, and this is called the original touch. Now you can place a limit order at the base with your stop loss above the zone and then look for a bearish candlestick pattern. It could be like an engulfing on a lower time frame at the zone, and you can see that here. This candle at 842 was bullish, and then the very next candle at 844 was a bearish engulfing. Now, in reference to the risk management part of it, I always recommend to have your stop loss just above the supply zone, and you can use this just as a buffer. You can also target a Fibonacci extension, and this can be opposite demand zone or support level. Now, the reason why this works so well is that there's liquidity tracking involved. Because for the most part, institutions want to sell into strength when retail is still buying. This then causes an imbalance. So the base marks a price imbalance where too many sellers versus buyers are existing. So just in general, some traders often buy too late into rallies, and this falls right into the trap, which is a no-go. So a couple pro tips for trading RBDs is that you want to use multi-time frame confluence. So look for RBDs on like the 1 hour, for example, or 4 hour, and you want it to align with the daily trend. Now right now I'm on the 2 minute, but I mentioned that at the beginning of the video is just for the precision. You also want to combine this with like trend line breaks. It could also be divergence or volume exhaustion for entries. But you do want to avoid trading a zone that has been revisited too many times in a short amount of time because orders are already likely fulfilled. Now, RBDs work better in a downtrend or at the end of a bullish correction. So those are the main factors to take away from this. All right, so now we're going to go ahead and move on from Apple, and we'll take a look at NVDA here on the top right. And on this chart, we're actually going to take a look at a rally-based rally. Now, this is a pretty powerful continuation pattern, of course rooted in supply and demand trading concepts as well. Now, unlike trend lines or indicators that lag, the RBR highlights heightened activity, specifically areas of demand, where price pauses before continuing upward. Now, this is where buyers re-up their positions or settled enough sell-side pressure to push higher. So let me go ahead and break it down from top to bottom so you can spot it, trade it, and use it to your advantage. Now, I am on the 15-minute time frame here, just to provide a little bit of a larger scope on this specific breakdown. So a rally-based rally for the most part, again, is going to be a three-price structure. Of course, you have the rally. This is going to usually be aggressive as far as the move upward with large bullish candles, and you can see that here. There's then the base that is created, which is basically like a pause or tight consolidation. And this is generally going to be small candles with little volatility and very controlled. You'll see a couple of them that have larger bodies, but for the most part, if we were on like a 2-minute and I was looking at this on a smaller time frame, you will see that conviction in the body of the candle shorter. Now with this pattern, this signals that buyers were in control. They took a breather to fill more orders and then push higher to gain control once again. So the structural breakdown is of course going to be the first impulse, which is the set of candles here. They're strong and bullish as far as the momentum. So of course they're big body green candles. And you'll also notice that they have very little to no wicks at the bottom, which shows high buying interest, possibly from larger institutions or funds. And then when you take a look at the base here, these are going to usually be smaller body candles that show indecision. And the price goes sideways or slightly retraces, as you can see here. Now, I will admit that this specific pattern does look boring, but this is where large buy orders get executed with forethought. So institutions buy from late sellers thinking the move is over. However, that second impulse, which is that second rally to the top, this is another surge upward, usually faster and stronger than before. Now, this confirms that buyers have overwhelmed sellers in the base zone. So it's good to keep in mind that the base in an RBR is where the market makers, institutions, or even like algorithmic buyers, where they accumulated the positions. So when price returns to this area, there's a high probability that unfulfilled buy orders are still sitting there, making it a premium entry zone for a long position. Now, I will say not all RBRs are created equal. So essentially what defines a high probability one is a strong initial rally to the upside as mentioned. It should be clean, fast, and has little to no choppiness. You also want to make sure that the base is very tight and has those small body candles as mentioned. Ideally no more than 6 for the most part, but again, I'm on the 15-minute. And the reason why you don't want a whole bunch of lingering candles is that you don't want the price to hang out too long. You also want to see a very strong breakout of the second rally. So this means that there's larger bullish candles leaving the base with energy, because this confirms it's a true RBR, not a weak flag or a pause. Now the best zones are those that are untouched since the creation. The more untouched, the more likely that buy orders remain. And this is even better when aligned with higher time frame support or like a trend line bounce. So in order to trade this effectively, you want to first mark the demand zone. You then want to draw a zone around the base from the lowest wick to the highest body of the base. And that's where institutions were buying. You then want to wait for the price to return. Now the first retest of the zone is usually effective because the price pulls back and touches the demand zone. So that's your window. So placing a buy limit at the top or the middle of the zone and then having your stop loss just below the base, that target is going to be the next resistance or a recent high if you choose to use that. And then from there, the best recommendation is to wait for the bullish price action when the price touches the zone. So again, this can be in the form of like a bullish engulfing candle. It could be a rejection wick. It could even be a break of a small downtrend within the pullback. Now, the reason why this pattern works so well is that smart money positioning is involved. So institutional buyers create liquidity during the base. And there's also usually an imbalance of orders, so there's more demand than supply. Now, because of that, some retail traders get faked out. While price looks like it's topping, it's just reloading for the most part. So using an RBR in a larger trading strategy, in an uptrend, you want to use the RBR zones to enter long on dips with confidence. At key levels combining with a support level, it could be like, again, the fibs can be your best friend for this, for the retracements, for even stronger confluence if you need it. And then in trend continuation plans, you want to ride wave-based moves. So impulse, correction, momentum, RBRs fit in the correction zone perfectly. Now an extra tip is to avoid old zones. So if a zone has been tapped multiple times, orders are probably filled or at least at capacity. So you want to use higher time frames to spot cleaner RBRs, such as like the 4-hour or daily charts. Again, these hold more weight. You can also add the volume as well, because a volume spike on the second rally confirms that buyers are back in control. And then just a couple common mistakes to avoid is that you don't want to enter too early, so don't buy during the base, of course. You want to wait for the breakout and full return. You also don't want to ignore context. A good RBR in a downtrend is less reliable, so you want to trade with the trend direction. And then lastly, you don't want to overlook the wick traps, because sometimes the price dips slightly below the base to trap shorts, so it's highly recommended to use a screen on stops. Alright, so that's everything with NVIDIA and the RBR. Now we're going to go ahead and take a look at Google down here at the bottom left. And with this, we'll take a look at a drop-based rally. Alright, so let me go ahead and scroll it back over just a tad bit. And we will go here, and I'll zoom it in just a little bit as well. And pull it up out there. Alright, so now taking a look at this pattern, for me, I feel like this is a blueprint that exposes where big money buyers stepped in after a downtrend, and it flips the market structure, igniting bullish momentum. So I like to think of this as if it isn't just a pattern, it's a close look into institutional behavior, perfect for identifying key demand zones with high reward to re-risk setups. So to unpack this, we'll look at full conviction on this specific strategy. Now, the main thing to know is that the DBR signals a market reversal from selling pressure to buying strength. So the first thing to know is that the price falls steeply, creating panic in some cases and attracting breakout sellers. The base then forms, and this is the price pausing and consolidating in a tight range. Now, this is where smart money starts to accumulate long positions. From there, you'll see the price surges upward, leaving the base decisively, confirming that demand took control. Now, the first drop is the impulse. So this is the sell move. This is typically going to show you that there's strong bearish momentum and there's big red candles, minimal pullbacks, along with emotion-driven panic or trend continuation, either or. Now, either way, this typically traps late sellers at the worst possible spot. Now, the base is then presented, and of course, this is the accumulation zone, and you'll see small-bodied candles ranging behavior, and it's usually 2 to 6 candles ideally, and you'll see wicks at the top and the bottom with low volatility. Now, this is where buy orders get stacked, but price stays flat to avoid slippage. Now, the reversal rally is typically going to be a strong bullish breakout. Now, the price soars out of the base with large bullish candles. And the volume often spikes a bit, but not always at an extremity. But one thing is for sure is that buyers overwhelm the remaining sell side pressure. Now, this move confirms not just a bounce, it's the beginning of a shift. Now, why the DBR zone is so important is because this becomes a demand area, a location where if price returns, it's likely to bounce again, simply because there's unfulfilled institutional buy orders typically sitting on the sideline. And since it's the origin of the rally, market traders remember the sharp reversal and treat it as support. Now, the perfect way to trade a drop-based rally is that you want to make sure you can identify the base forming. Now, logically, you can mark the base using the low of the base wick to the high of the base body. But you want to avoid those with wide bases, so no more than 6 to 8 candles once again, just to avoid too much back and forth on the range. You also want to confirm that the price left the base with certainty with the large green candles. Now, with the first retest of the zone, this is usually the cleanest. So you can set alerts just before the price reaches the zone, and the goal is not just to chase the rally, but to wait until price returns to the base for a precision entry. And you can enter using one of either of the two methods. You can buy a limit order at the upper third or midpoint of the base. You can have a stop loss just below the base wick, or you can target the previous structure's high or extensions. But you want to make sure that it's confirmation based. So wait for the bullish candlestick patterns. Same goes for this as it can be for like a bullish engulfing. It could be a pin bar. Any of those could work. You can also drop it down to a lower time frame as well. So if you did have it on like a high time frame, for instance, if the base was viewed on like the 1 hour and you're seeking a quick entry, you can gain confirmation on like the 5 minute, for example. And this just allows for a tighter stop loss and is very accurate entries. Now, the main reason why this works is that it traps late sellers. So those who shorted late, they may then see it as being forced to buy back when price reverses. And institutional leverage becomes relevant as they need a base to execute large orders without causing major gaps in the bid-ask spread. Now, because there is typically an order imbalance, price rallies when buyers outweigh sellers dramatically. Now, how to spot a high-quality DBR zone is, again, you're going to look for that sharp, clean drop. You want to avoid any type of choppy decline, so you want it to be very steep. You also want to see a tight base, so fewer candles, small bodies, and low wicks. And the rally away should be definite, and of course, it should also be forceful. Now, the best demand zones are tested only once or are untouched completely. Oh yeah, and then the volume may spike on the rally, and this just confirms real demand is there. So using DBR in broader strategies, of course, it can be for trend reversals, And the same rules apply. You want to look at it on multi-time frame confluence. So use it at the end of a downtrend to catch early shifts. So for example, a DBR on a 1 hour that aligns with the 4-hour support is a strong signal. And if you're swinging your entries on higher time frames like the 4-hour, the daily, these zones offer plays with swing level upside. On the other hand, if you're scalping or placing intraday trades, the 5-minute, 15-minute DBRs offer great scalp entries that are efficient as well, so don't feel restricted. Now, a pro tip is to combine this with RSI divergence. So a drop in price with the RSI rising will tell you that there's a strong reversal signal. And you can add the fib retracement levels. So a DBR around the 61.8% retracement is a gold mine. So do your best to mark your zones clearly and don't overcomplicate. Precision always wins. And then a few mistakes to avoid are going to be chasing the rally, of course, so never do that. Just wait for the pullback. You also want to use wide zones, so the tighter the base, the stronger the move. Also keep in mind that a DBR is strongest when it reverses a larger structure or fills a gap. And once again, the more times a zone is touched, the less effective it becomes. Now, a drop-based rally isn't just a setup, it's really like a positioning or a roadmap for high probability trades. So when you spot it, you're essentially stepping into the ranks of big money before the crowd of traders fully catches on. Alright, so last but not least, we're going to go ahead and take a look at Microsoft here, and we're going to look at a drop-based drop. Alright, so let me scroll this back over. We will take a look. Right here is about good. Alright, so a drop-based drop. So this one is typically a little clean continuation pattern in supply and demand trading, but it's brutal if you don't see it coming. Now this pattern, it reveals where institutions paused after a sell-off, stacked more sell orders, and then hit the sell-off again, causing the next drop down. And I truly feel like traders who understand this pattern don't just follow momentum, they position themselves where momentum resets. So just to give clear understanding, a drop-based drop is a bearish continuation pattern that signals the market is loading up for more downside activity. And as y'all can see, it consists of a drop, a strong bearish move, of course. It has the base, which is like tight consolidation or like a temporary pause, and then a drop continuation of the bearish move to the downside. Now this sequence forms a supply zone, which becomes a key area to sell on a pullback. So it's definitely not random. It's strategically where market makers add or reposition short orders to continue driving the market lower. So it's a very predetermined move. So when we consider the drop, this is of course the initial sell-off. And this is typical of strong momentum of the push downward, often triggered by news, maybe an imbalance or trend continuation. Now these red candles dominate with minimal wicks. And this attracts retail traders to go short, and sometimes it's too late. Now this is the part where liquidity gets crushed, setting the tone for institutional control, so it's often manipulation. Now once we get to the base, this is of course going to be the supply accumulation zone here. Now this is where price stalls and moves sideways in a tight range. Typically you're going to see about 2 to 6 candles as well with low volume. Now the goal with this isn't to reverse, it's to breathe. So it's like a repositioning that absorbs the buyers. So it looks calm on the surface, but it's where smart money is quietly getting aggressive, so it's like a setup for the sell-off. Now the drop continuation move, this is a big bearish breakout out of the base. It usually starts with a strong red candle or one to precede it, so here for example, and it confirms that sellers are still in control. Now new momentum gets triggered in this case, especially from breakout traders. Now what the DVD tells you is that the market isn't done falling, simply because sellers are dominant and confident enough to re-enter after a pause. Now price is highly likely to return to this zone and reject hard if it ever retraces. And to prove that point, we can take a look here. We can see that once the zone kind of got tapped back into, we see the sell-off followed. Same thing here, kind of underneath the zone just a little bit, but again, the sell-off still followed. We see that happening again here, and then once again here, and then it also did it again here. So we can see that this continues to be a repeat of history within the market. Now the reason why this becomes a supply zone is that the drop-based drop creates the origin of the next wave down. So unfilled sell orders still exist in the base. Now institutions know this, so they use this level to distribute more shorts quietly. When price pulls back to it, those sell orders often get reactivated in a sense. Hence why you see that happening in this pattern in this sequence here. So to spot the structure, you always want to make sure you're looking for a strong initial drop, ideally multiple large red candles consecutively. You want to look for a tight base, again having small body candles, sideways price action is taking place, and then another strong drop out of the base. So you can use the wick high of the base candle to the body low of the highest candle in the base to mark your supply zone. But you always want to wait for the pullback. Again, patience always pays, so don't chase the breakdown in this case. So it's recommended if you need to go ahead and trigger some sort of alert, if needed, just before price touches the zone, then that would be a good opportunity to do that. But you want to wait for the first retest because this is generally the most reliable. So when you enter the trade, there are two entry styles that work like a charm. You can sell a limit order at the zone, you can set a stop loss just above the wick of the base, and then you can target like a 2-to-1, maybe 3-to-1 risk to reward ratio and have your levels below the structure. Now your confirmation on the entry is just waiting for a bearish rejection candle at the zone, and then you confirm the volume increasing on red candles, which allows for the tighter risk. Now when a DBD is high quality, here's how you can tell if you got a strong setup. When there's little to no overlapping of price action or choppy candles combined with a tight base, no more than again 5 to 6 candles always, because a super wide base loses validity and reliability. And then you want the second drop to be swift and decisive, because the best trades come when the zone hasn't been touched yet, and then more alignment with specific time frame trends so that you're not at all trading against momentum. Now, how to use a DBD in a larger strategy. Now, if you're wanting to make a play on an intraday scalp, you can use the 5-minute, 15-minute to fade the pullbacks during trend days. And then with swing setups, you can identify the DBD zones on the 4-hour or like the daily charts, and then look for confirmation on the 1-hour or 15-minute. Now, in reference to gap fills, you can combine with earning gaps or news-based drops by looking for a DBD right after the move. And if you want to trade the break and retest strategy, once the base breaks down, wait for the price to come back into the zone fully. Now the power moves are adding extra forms of confirmation, such as if the MACD or RSI divergence is not present. Hence, this shows that there's no bullish signs, which builds a stronger case for continuation. Or if the supply zone lines up with Fibonacci confluence of the retracement from the last move, it's prime. And just a couple common mistakes to avoid are forcing a zone. So if the base is messy, just skip it. Clarity and conviction is much more important. You also want to avoid chasing the breakdown. It's always better to wait for the price to come back to the origin, which is why you want to keep your stop relative to the zone because you want accuracy, not guesswork. And then always keep in mind that old zones, the more times it's hit, the weaker it gets. Now, a drop-based drop for me, when marked correctly and used with precision, becomes one of the most dependable setups for catching continuation moves early and with minimal risk involved. So yeah, y'all, these are the 4 main elements of price action that are commonly traded, of course, when analyzing supply and demand. So I hope that the visuals help connect everything. So with that, that'll pretty much do it for this video. If you found this information to be helpful, feel free to leave me a comment down below. As always, I thank you so much for watching, and of course, I'll see you in my next one.